Assalamualaikum and hi everyone. Welcome to my channel. I am Madam Yusna Lisa. Today we are going to have another session for the preparation of consolidated statement of financial position, and in this session we are going to discuss a question September 2022. This is a special examination and I'm going to discuss question 1. So let's look at the question. Okay, this is question 1, and before we start, there's a little typo there in the question. So if you can see here, I've already changed that numbers from 5 to be 3, so the figure should be 300,000 ordinary shares. So just make some correction there. So let's look at the question. So you're given the statement of financial position of Ranjau and Dury as at 31st of December 2021. So 31st of December 2021 is actually the reporting date. So we're going to prepare the financial statement on that date, the consolidated statement of financial position. The second sentence, you have the information on the acquisition of 350,000 out of 500,000 ordinary shares. So the shares were being acquired, and the total shares that were acquired was 350,000. So this information will give you some calculation to start with, which is to calculate the controlling interest. And 30% debenture that was on 1st of January 2020. So 1st of January 2020 is the date of acquisition. So this is the date of acquisition. On that date, the general reserve and the retained profit has a balance of, general reserve has a balance of 160,000, and where the retained profit has a balance of 100,000. So this is the pre-acquisition balances for general reserve and retained profit. And if you look, you have the information on the asset, equity and liabilities, and additional information. So before we go further with the question, let's look at the requirement. So you are asked to prepare the consolidated statement of financial position of Ranjau and its group as at 31st of December 2021. So when you are asked to prepare the consolidated statement of financial position, you're not just going to prepare that statement. If this is in the context of our question in FAR320, so we're going to also prepare the calculation for Goodwill, because the question requires you to show all the workings, Goodwill or bargain purchase. You're going to also prepare the schedule which show the analysis of the reserve and the non-controlling interest. And then number 3, you are going to prepare the consolidated statement of financial position, classifying the asset into non-current asset and current asset, and also the liabilities and equities. So the schedule here in the second workings part here, we have to also show some workings like maybe simple consolidation journal entries together with workings. I'm going to show you the workings before we can proceed with the schedule. Then we can prepare the consolidated statement of financial position. Before that, let's look at the template that you need to prepare. So I have already prepared the template here. So you can see that this first part here is the computation for the Goodwill and bargain purchase. So you need to do that. Then you need to also prepare the schedule, which shows the analysis of the reserve and the non-controlling interest. So you can see that I have put a few columns there, where you have the Goodwill, the group retained profit, GRP, group general reserve, and non-controlling interest, and also the adjustment column. So you have also a few headings here. This item, retained profits of the subsidiary and retained profits of the parent company, and the general reserve of the parent company and the general reserve of the subsidiary. So the reserve that you will prepare here will depend on what was given in the question. For example, you can see here in the question there are two general reserve, 1 and 2. So non-controlling interest will be another one. So you're also going to look if there is any new reserve created during the consolidation adjustment. So after then, you're also going to prepare the template for the consolidated statement of financial position. This is a classified one, but you can prepare a simple one for examination purpose. You can just show the workings next to the item. You don't have to put this columnar format, but this is just a matter of to make things better. But you don't have to do this in final exam. So you just make things simpler. So we have non-current asset here, current asset, classify them into its categories. And of course, you have the equity liabilities and reserve and non-current liabilities. So these are the so-called template that you need to prepare. And as a start, we're going to prepare normally the controlling interest or calculate the controlling interest before we can proceed with the calculation of goodwill. So let's look at the information. So you have the information on the acquisition of ordinary shares and debentures. So if you can go to the question here, if you can go to this section, investment in Dury, you can see that the figure here, 300,000, I've made the correction. This one should be the same as what we have highlighted here, the one here, right? So 300,000 was being acquired, and then debentures were also being acquired. And the consolidation transferred for the ordinary shares was 1.5 million. Consideration transferred for the debenture was 1.2 million. So this is the starting point if you want to calculate the goodwill. But before that, we need to calculate the percentage acquired. And you would notice that in ordinary shares of the subsidiary, the number of shares was given here. The number of shares is given here, 500,000. But you can see here, the amount here is 1650. This is actually 500,000 units times 330. So if you do that, you get 1.65. So meaning to say 1.65 million is the amount, and the fair value was 330. So that was for the subsidiary. So you have to go and calculate the controlling interest. So if you look at what was being informed much earlier, the ordinary shares were acquired and the debenture were acquired. So the preference shares, however, was not being acquired. So you need to understand that this portion belongs exclusively to the non-controlling interest. So there is no acquisition. You don't need to calculate the goodwill for the preference shares. Now we're going to do is to calculate the percentage acquired by the parent. So for the ordinary shares, it will be 350,000 divided by 500,000, and for debentures, it was given. So I've already calculated this here for you. You can check this with your answer if you have tried this question. If you want to download the question, it is available in the description of the video. Go ahead and download them. And these are the information. You have 70% of the controlling interest, 30% belongs to NCI. For preference shares, 100% belongs to non-controlling interest, and for the 8% debentures, 30% and 70% belongs to other debenture holder. Now you can start with calculating your goodwill. To start calculating your goodwill, you have already prepared the template. So the first part of it would be to calculate the goodwill for the acquisition of ordinary shares. So you have been informed that the goodwill for acquisition of ordinary shares was given in the question. So if you go to the question, you have this information, take this consideration transferred, and you need to go and find out the non-controlling interest, since no information is informed on what was the non-controlling interest on the date of acquisition, you are going to assume that it is measured at the proportionate share of the net asset in the subsidiary. So therefore, you need to go and calculate what is the fair value of the net asset. So fair value of the net asset is the one available on the date of acquisition. So you need to go and take this figure, which is 160, 100,000, which is the retained profit and the general reserve. And you also need to take the ordinary shares of the subsidiary. So let's just put this side by side in so that we can have a better view next to each other, which is showing also the information on okay, that's better. So you can see here, I'm going to put here the fair value of net asset. Before we start calculating that, you need to check first if there is any bonus issue or fair value adjustment. So in this question, there is a fair value adjustment in number 1. Remember, we're trying to calculate the goodwill. So therefore, we start with the information that we have, which is the consideration transferred, and we're going to calculate the fair value of net asset first. So we're going to do that first on 1st of January 2020, the date of acquisition. So if you look at information number 1, as I've highlighted here, on the date of acquisition, the fair value of the plant was 60,000 more than. 60,000 more than means there is a surplus on the date of acquisition, but that has not been reflected in the financial statement. So this 60,000 was a surplus, and this 60,000 was a pre-acquisition surplus by the subsidiary. So it was acquired on 1st of January 20, and the year end of the company just now was 31st of December 2021. So therefore, you need to go and record the surplus that has not been recorded. So to record the surplus, the journal entry is for you to debit the asset that was being revalued was plant of the subsidiary, Dury, and credit the asset revaluation reserve plant of Dury, and this is during the pre-acquisition period. So how much is that? 60. And that must be reflected in the fair value of net asset. So I've already done this for you. So you can see here, that was the first one. So that was orange share, sorry, but you would see that I've put it here, which is at this row here. Okay. Then you have also the orange share capital. This is the one from here. You should also take the one on the date of acquisition, the general reserve, and the retained profit. Remember, there is no bonus issue. So if you have any bonus issue, you may have to adjust the figure to reflect the bonus issue, should that be out of pre-acquisition reserve. But here you just copy and paste that amount here. Okay, so that was directly from here and here. So that was that 160 and 100, and this is from this adjustment. So you total up. If you total up, you would see that the fair value of net asset would be 1.97 million. And now you can calculate your non-controlling interest, which is 30%. Remember, non-controlling interest, 30% times 1970. That was a non-controlling interest on the acquisition date. Remember, that was the information given in the question, so you need to be able to pick up. So the first round here is to calculate the goodwill. So you have already got the calculation for the goodwill on the acquisition of ordinary shares. So now we proceed with the second one, which is to check in case there is any goodwill on the acquisition of debenture. Remember, this was the one that we're going to do. So I start with that figure, which is 120,000. That is the acquisition of the debenture, the consideration transferred. Then under first paragraph, you were informed that 30% was being acquired. So you need to go and calculate in case there is goodwill. So to calculate that, you will find how much was being acquired. So it was 120 based on the information here, 120. And therefore, you can now compare with the that figure with the consideration transferred, and therefore there is no goodwill because consideration transferred is equal to the carrying value of the debenture acquired. So that was actually acquisition of not 12%. There was a typo there. This is acquisition of 8% debenture. Just make that correction. So there was none. So then we can proceed by checking if in case there is any adjustment to the goodwill. So if you can go through, that was information number 7. And that is regarding impairment of goodwill. So your total goodwill would be 121,000, but there was an impairment, and that impairment will reduce the goodwill to be down to 80,000. And this is the goodwill that you will reflect in the non-current assets section in the C of P. So, but we have already done this part. And remember to include this later in the adjustment of the retained profit for the group or the retained profit of Ranjau. Reduced it in the adjustment section. And before we forget about number 1, there was another adjustment that you need to do for number 1 because there was a surplus. Surplus will normally need to for you to adjust the depreciation, and depreciation here is the one that was being under provided. So you just do a simple workings here. You just take 60,000 which is this 60,000 here, and you are informed that remaining useful life on the date of acquisition, remaining useful life was 5 years. So that has not been adjusted. So you take 60,000 divided by 5 years, and therefore that will give you a figure of that should be how much? It should be 20 of 4,000 because you need to also multiply with 2 years. Why multiply with 2 years? Because from here up until the end of the current year, so it has been 2 years that it has not been adjusted, so that should be 24,000. And the depreciation that was being under provided here is how much? 24. So I just enlarged that size for you. So you will debit the retained profit of the subsidiary, here is Dury, and you will credit the asset account here. Since there are no accumulated depreciation, you will credit directly to the plan of the subsidiary, and that should be under Dury. How much? 24. And remember to include this 24,000 in the fair value of net asset calculation, in the schedule, and also in the SOFP. So that will be done later, but I will show you the one in the schedule first. So let's look at that here. You can see that the schedule here, I'm putting it under Dury. So information 1 is here, but before you do this and put here, my suggestion is that you start putting the balance carried forward for the item, which is the item retained profit. So let's just put the figure first and take the balance carried forward and reduce that with the pre-acquisition balance. Where do we get this 380? 380 is the one here, this one. So remember to include all the figures that are relevant to the schedule. So 380, and the pre-acquisition profit is the one here, 100. So you will take 380 and that will be shown here. And therefore you will have a post-acquisition profit of 280. And the adjustment that you just did for your under provision should be included in the workings here. So this is the adjustment that you have. So these are the adjustments that you need to include. Okay, next we go to the second one. The second one is to do the workings for the item on unrealized profit on closing inventory. So if you look here, you see that you need to go and identify what was the issue here. So the closing inventories, so I'm going to take a different color. Okay, take green. So the closing inventories of Ranjau included 150,000 purchased from Dury. So identify who is the seller. Seller here is the subsidiary Dury. And remember, the adjustment for unrealized profit must be done in the retained profit of the seller. So we will be doing that in retained profit of the seller, and the seller here is Dury. And unrealized profit here is to remove the profit that earlier had been recognized, and since at the end of the year some of the goods were still unsold, so that must be removed. Unrealized profit for the closing inventory. Closing inventory. So to do that, you need to check how much is the intercompany sale, intercompany purchase, 150,000, and there was a markup here of cost plus 20%, 40% were unpaid. So to calculate that, you will take 150,000, and that was the goods that were not sold off because it was included in the closing inventories of Ranjau. So times 20 over 120. And that one will give you the figure for unrealized profit. And you need to do some calculation there. So if you had done that, that figure should be included here. And that should be 25,000. But in terms of journal entry or the adjusting entry, consolidation entry, this is where you debit retained profit of Dury with 25,000. Make sure to include that in the schedule and credit the inventory of the buyer Ranjau with the same amount. So that was the case there. However, there's another information here on 40% of the goods were still unpaid. So it means that the amount was still owing among each other. So meaning to say that we need to do another adjustment, which is the adjustment for trade receivable, intercompany trade receivable and trade payable. So how much is that? 40% from the 150,000. So if you do that, you're going to debit the trade payable and credit trade receivable. How much? It should be 40% times 150. So if you do that, that will be 60,000. So that must be removed in the workings that you will show in the preparation of the consolidated statement of financial position. So I will show you here the one that I've already prepared, the template, remember. So here at first we have this item. We are doing actually information 2. Information 2. Okay, we start with the first one. That was the inventories adjustment. And then just now we were doing adjustment for trade receivable. the amount that you need to remove is 60. So remove that, eliminate them. At first, you just add the parent and the subsidiaries figure, but the elimination will be the consolidation adjustment, eliminating intercompany transaction. And there's another one here that you need to go and eliminate, which is the one in the current liability section, which is eliminating the trade payables. So that will give you a reduction because credit, trade receivable, and debit, trade payable liability is reduced to 1.07. Then we have another one, which is our our debenture interest. So let's take another color. So you are informed that directors of both companies have not provided for debenture interest payable at the end of the year. So this one is actually situation 2, where both holding and subsidiary have not recorded the debenture interest, situation 2. So you can check your consolidation issues on dividend and debenture interest. So what you need to do is you need to go and record on behalf of both company. So let's start with the one of holding company itself. Remember, holding also will provide debenture interest. At the same time, subsidiary will provide debenture interest, and some of the portion will be shared by the parent company. So for the holding company, the 8% debenture interest will be based on this 500,000. So let's look at and do that. So there will be retained profit of Ranjao, and that would be 8% from 500,000. That would be 40, and you would credit the debenture interest payable in Ranjao of 40. This will be adjusted in the schedule, and this will be adjusted in the current liability in your soft B. That was the first one. I put here as A. B. You also need to go and do the same adjustment for Dury. Dury also declare debenture interest, but the percentage is still the same, only that the carrying value was 400,000. So you have 8% times 400,000. This is for 1 year. So therefore that would be 32,000. So that will be credited to debenture interest payable in Dury. 32. Remember to include this in the current liability, this one also in the schedule. However, for the one declared by Dury, some of it, I put here C, will belong to the parent because parent has not taken credit of the debenture interest since the subsidiary has just declared the debenture interest. So therefore, the one belonging to the parent company will be credited to the retained profit of the parent, Ranjao. Remember, in the question, it was informed that 30% was being acquired in the debenture. So 30% times 32. So you get the figure. You will have to calculate that. But what we're going to do now is we're going to calculate and put that, reduce that from the debenture interest in Dury, how much. So to do that, you need to calculate, and the amount would be let's just check. I've already done the calculation for that part, so that was done here. It was done here. So that was information 3 for Dury. This is the one that we did for B just now. And for the case of Ranjao, you need to do the same information 3 Ranjau declare the debenture interest, and also Ranjau receive the debenture interest. So the figure here just now that I was calculating what should be 9.6. This is another one for the part declared here. So therefore here is 9.6 million, 9.6 million. Sorry, 9,600. And this will be adjusted again in the schedule, and this will be adjusted in the schedule as well as in the current liability. So this one will be credited, so you have to add in the retained profit of Ranjau, and this would be also reduced in the current liabilities. So let's look at that here, the impact here. So that was the two things that we just did. Next, that was done with number 3. Let us look at number 4. Number 4 is situation 2. Situation 2 is where subsidiary has recorded the dividend and debenture interest. In our case, it was recorded in adjustment number 3, but we are focusing on the dividend as recorded, but the holding company has not taken credit, has not credited. So what you need to do is to credit on behalf of the holding company, record on behalf of the holding company. Okay, let's look at what you have here. This 60,000 you shouldn't credit to the retained profit of the holding company Ranjau, because this is not acquired, so all this belongs to the non-controlling interest, since this is preference dividend, and remember we don't acquire preference shares. The one that will be credited is this 300,000, and our portion, remember, was 70%. So if you do this, you will have 210,000. So that is the portion that you should have credited. And this dividend here, or dividend payable here, is the one that you must report in the consolidated statement of financial position under current liabilities. So let's look at the one that relates to 300,000. So this is the one that we will debit to our ordinary dividend payable that was given in the under Dury. How much? It should be 300,000 times 70%, so that would be 210, and that would be credited to retained profit or group retained profit, which is Ranjau, 210. So go and add this to the schedule. Go and reduce this later when you prepare the C of P current liability. So current liability will have been reduced. So that was number 4. For interest, we have already done earlier in number 3. We have already taken credit for the debenture interest receivable from Dury. Let's look at number 5. Before that, the impact of number 4. The impact of number 4 is here. So you can see that that was information 4. So information 4. You record this, you can do the workings here, 300,000 times 70%, and the figure here would be 210. Right. Next one is the bills payable. For bills payable, this is an easy adjustment because half of the bills payable were in favor of Ranjau. Your duty is to find out how much is the undiscounted bill. So here you are informed half here, if you can see, bills payable of Dury. So if you go to bills payable of Dury, you are informed that half of it, which is 65,000, so half of that were between group members in favor of Ranjau. So we will have to assume that these are all not being discounted, so undiscounted bills. So what you will do is they will be debiting the bills payable of Dury, and you will credit bills receivable of Ranjau. How much? That would be 65,000. 65. Do go and adjust this in current liabilities, adjust this in current asset, reduce them in the C soft B. So that was number 5. So let's go and do that straight away to our C soft B and just increase the size here. Okay, you can see that the bills payable and bill receivable have to be reflected. So I'm going to put it here. This is the one, bills payable, and you have reduced it by 65. Bills receivable, sorry. Bills payable will be here, and that would be reduced by also the same amount, 65. So the bills payable was to be added first, and then to be reduced with the intercompany transaction. Right, there were no bills payable, but the bills payable were all related to the group member. Next, let's do the next one, which is almost finished now. Number 6. Number 6 is intercompany sale of PPE. So I'm just erasing this to get some space here. So number 1 that you need to do is to identify who is the seller again. So Ranjao had sold the motor vehicle for 320,000. Ranjao is the seller. So motor vehicle, the proceed was 320, and you are informed that the carrying amount on the date of disposal, if this is not given, you need to go and calculate yourself. So the carrying amount on the date of disposal, these are all on the date of disposal, 280. These are all on DOD, date of disposal. You compare that, you will have 40. The profit was charged earlier on the sale. However, the motor vehicle still remain with group members, with the buyer, and therefore this 40,000 that was earlier recognized now must be eliminated, and we are making provision for unrealized profit. So to do the adjustment, we debit retained profit of the seller, Ranjao, and we will credit the motor vehicle of the buyer. Buyer is Dury by 40. We'll do the adjustment in the schedule. This one will be in the soft B under non-current asset. Top of that, you are informed that the depreciation charge was 10% yearly basis. So this is telling you that it was on cost. So you need to go and do adjustment since it was done in the same current year. Remember, our year end was 31st of December. So your depreciation will still be charged for 1 year, even though it is just 6 months, right? Here it is because it is having yearly basis. So the over provision, the over provision of the depreciation should be from the date of disposal till the current financial year end. So our case here, we just take 40,000, this the unrealized profit, times 10% times 1 year, because that was just within 1 year period, and that was yearly basis. So you will have here 4,000, and this 4,000 was being over provided, so you will credit your retained profit to reduce the depreciation under Ranjao with 4,000, and you would debit the motor vehicle of Dury 4,000. This will be done in the soft B under non-current asset, and this will be done in the schedule to the retained profit. So you're done with most of the adjustments. So let's look at that adjustment. So this one, you should be here. So if you look, that's another two adjustment that you need to include here, which is the unrealized profit we did calculate just now, and over provision. You can also do the workings here, 4,000. And at the same time, remember earlier we did the adjustment for goodwill impairment. And that goodwill impairment was the figure that you have calculated much earlier here, 41. Okay, now you can proceed with the schedule analysis. So remember to include the non-controlling interest on the date of acquisition as well. Under ordinary shares, this was the figure here, 591. This one, you put it here. And for the non-controlling interest, remember I've highlighted much earlier, that was 200,000 since there were no acquisition of the preference shares, the one here. So this 200,000 belongs to the NCI and you will include here, right? You can total up the one of the subsidiary. It is 199. This is the adjusted post-acquisition profit considering the adjustment. The one relating to the group retained profit will be based on 70% times 199. You will get 139.3. And the one relating to the non-controlling interest would be the difference, which is 30% from 199. Then you will have to include the figure for the holding company. We have done all the adjustment. Next part is to do the general reserve section. So that first put the balance that you have in the soft P, balance carried forward. That was given. Which one? You may ask me. This is the 630,000. And the one in the subsidiary company will be 500,000. So you put here. However, under holding company, there's no adjustment unless maybe bonus issue was issued by the holding company. But in your case here, no adjustment. So I just simply put the figure here. And for the general reserve, you need to reduce that with the pre-acquisition general reserve balance given in the first paragraph, which is this one, 160. Then you will have the post-acquisition general reserve. And therefore, that will be divided among the group general reserve, the parent share, and the non-controlling interest share. If you do all this adjustment correctly, your calculation should give you an NCI of 952.7, 868 for the group general reserve, and 991.9, which is 991, right? 991,900. And the one that will be shown in the 6 of P will be this figure. So let's look at what we have here. Those are items that we have adjusted. So let us look at this section now, which is our consolidated statement of financial position. Just bear with me. Okay. So you would see that in the non-current asset, you will repeat the figure that you have. You will copy the figure that you have from the question for land and building. Land and building has no adjustment, but you still need to combine the figure. So when I say combine the figure, I'm just going to show you which one. It is going to be this. Just put it side by side, easy for you to refer. Okay. So this land and building. Okay, I'm taking it from here. All right, and now we take the plant and machinery. And the plant and machinery would be also adjusted since there are adjustments for plant and machineries. Yeah, we have adjustment for the unrealized profit and also the adjustment for unrealized profit and the under over provision of depreciation. Remember, we did that adjustment much earlier. And you also have the item for motor vehicle. So this one was a surplus, and this is the under provision. This was not intercompany sale, this was a revaluation. You can check the information that I provide here. So that was actually recognition of surplus and to decrease the depreciation under provided. Then you will have to complete the next one, which is the motor vehicle. And don't forget to put the goodwill too. So the goodwill is 80 unimpaired goodwill, and these are all the one that relates to our motor vehicle that was involved in intercompany sale. So next is to do the adjustment for the bank balance. If there is any, there is none, you just need to add if there is any. So the other investment is the one here. So we have done all for this, now we're doing for this. Just add them. Right, this one do not include because you eliminate. So other investment, and then you have also your bank. In case there is any cash in transit, you may need to also adjust. Here there is no cash in transit. Sometimes you may also have inventories which are in transit. You may need to adjust inventories, but here there was none. So the total here would be 9310. Next we go to the equity and liability. So first, just include the share capital of the parent. Group retained profit will be reporting the one in the schedule. This one we have already done the schedule. Remember the figure in the schedule here. You just need to copy this figure correctly and put it to the correct row. Next, the non-controlling interest was 952.7. The non-current liability that you will report here would be the debenture, and that 8% debenture after the one deduction of the amount acquired by the parent. So the amount that you would report is 780. The one of the subsidiaries are being eliminated according to the percentage acquired, 30%. Then the current liability, you are done with that. I'm going to show you the calculation for the dividend. So on dividend payable, you are reporting this again, 70 here, sorry, 400,000, sorry, 400,000, and 300,000 is reported, but you reduce with the intercompany transaction. For preference dividend, I just report the 60,000 straight away, since there are none of it belongs to the parent company. Debenture interest payable was from our adjustment that we did here, this one and this, and we reduced with this. So therefore that was 62.4, and you will have your item now tally. The total asset and liabilities will tally. So this is what you have. I put a little note here. You can check what you have from the beginning. Okay, that's it. And these are the note that I include to explain further on what we just did. So you can also screenshot this in case you want to have a copy of the answer. Okay, with that, I thank you for watching. I'll see you when I will see you. Assalamu alaikum and have a pleasant day ahead.